by thanking just NAOP, Claire's team here for helping set up, of course, DLR Group for hosting us. Really appreciate the hospitality. And then our sponsors too. So our premium sponsors, Outwell, Tarragon, and then our other sponsors, Bercadia, Hills, Clark, Martin, and Peterson, Hit Contracting, Holland Partner Group, Invesco, Kimley Horn, Moss Adams, Panatone Development Company, Underwood Gartland, and then Urban Renaissance Group. And then, of course, we'd like to thank Chris, too, for taking the time and meeting with us. Prior to forming Fourth Avenue Capital, Chris spent over a decade at the Wolff Company, a Scottsdale-based multifamily owner and developer, where he served as SVP of Development, overseeing the Northwest region. At Wolff, Chris developed more than 5,600 multifamily housing units, totaling more than $1.4 billion of investment. While at Wolff, Chris served on several projects where he received national design and industry awards. Prior to joining Wolff, Chris was a partner at Urban Evolution, a Seattle-based multifamily housing developer focused on the development of mixed-use urban housing communities. Chris is a graduate of UW, and he also completed the CRE certificate program in addition to his master's. And Chris serves here as our incoming 2025 NAOP president. So we're in the presence of royalty. With that, too, I'll just open it up, Chris, to you to just maybe give a little bit more color around your background and kind of the quick overview to the extent you can, and then we'll dive into questions.
Yeah, that's great. Thank you. I was mentioning earlier, the last time I was in this space was actually in this seat doing this 5 years ago. So it's fun to be back. Life is a lot different than it was in 2019. So I feel a lot older than I was, and that was only 5 years ago. But no, great to be here. I touched on all the highlights of kind of my career from a high level getting here. But, I think really the fact that you guys are all here, the fact that you're all involved in NAOP, I got to do my NAOP plug. And I've always been doing the NAOP plug. Steve, I know, has a good NAOP plug for most events. But I started NAOP in 2010, I think. Immediately joined the membership committee that Steve was on. And it was a great opportunity to kind of take a big industry in a medium-sized city and really break it down to like a very kind of bite-sized level, right? To meet a lot of people, to understand who's doing what, to build a network. And so just thank you guys all for being here, for participating in NAOP. For those of you that are members, I will tell you that for me, I've gotten way more out than I put in, and I put a lot of time into it. But I would just encourage you guys all to get involved because I think it's a great organization, great people, and that's my plug. So
Perfect.
Yeah,
I always need a good NAOP plug. Well, Chris and I met before this, and one of the things that stood out to me was your transition from the CRE program and into your next career and kind of how that dual tracked. And I figured it'd be a great kind of lesson for everyone here to just talk through kind of what that experience was like and some of the lessons learned.
Yeah. I'm sorry, transition from
you were in the CRE program,
Yeah.
And you and a business partner kind of started a consulting.
Yeah, so very much like this time, back in 2010, up until that point, I didn't really focus more on the consulting side of the business. So back from 2004 to really 2008, this market was really dominated by condominium development. So at that time, residential mortgages were very easy to come by. My first condo that I bought in 2006 was literally zero down, 100% financing, super low interest rate. And I was like, shit, I should buy like 20 of these things, right? And sure enough, that's what everybody did, right? And that's why the bottom fell out. Luckily, I didn't. But up until that point, it was coming out, I got out of college in 2006, and I worked in that business from 2005 to kind of 2009, 10. And, when things are good and you're young in your career and, the market is rising, you don't really learn how to manage risk. You don't really understand like what potential impacts there can be. And so going through the downturn, especially in the condo market where, it's not like apartments where, you lower your rent by $50 and you get the building full, and then that lease turns over in 12 months and you raise the rent back up and you live to see another day. In the condo market, you just had buildings you were completing that were empty, right? Your loans were coming due. Nobody wanted to take the building back. A lot of them went to auction, and it was just a really bad time to be a developer. So at that time, I went back and did the CRE program at UW. I thought, hey, I want to go from being a service provider to being a developer. That was always my goal. And I thought that it was a good time where the market was down, things were slow, and it was a good time to go kind of get educated on making that transition. So as we were talking about the other day, I was in the cohort from 2009 to 2010. And the number of groups that companies that were started out of that class, I think there was 5 or 6 that to this day are still active developers that started their company in that program in 9-10. And really I think the catalyst there was like, there was no barrier to entry. And so at the time I started a business with a partner, and our whole thesis was to go out, buy land at a discount because of the market dynamics, and build infill multifamily kind of mixed use podium projects. And we were able to go out and get control of sites that we had no business controlling. For where we were with our company, where we were with our personal balance sheets, capital relationships. Had we fast forwarded that start, let's say we delayed that start to 2014, the stuff that we controlled, we never would have had a seat at the table. So that was a big kind of learning lesson for me, in that, when these market corrections hit, institutional capital goes to the sidelines, institutional players kind of have to follow suit. All of a sudden, it opens up all this opportunity for the little guy, right, to go in and take a chance and really build something. And so now the past couple of years have been very, very similar. And I think for me now with my company, we saw a similar opportunity that kind of harkens back to that experience in 2009, 2010. And I think we're still there. So, that's something that hopefully you guys are all taking advantage of. And I think those that do will get rewarded for it.
Yeah, and maybe expand on your first acquisition too. It was in West Seattle. And that's actually how you came across the Wolff Company too. I guess maybe kind of walk us through how that deal more or less came together, and maybe some of the challenges in identifying the first deal.
Yeah, so going back to the whole NAIOP plug, it's not a NAIOP connection, but our business is all about relationships, especially if you're out doing deals, if you're a service provider. At the end of the day, you make connections, you end up getting deals done with people. And at the time, my partner and I, we were out, wanted to get our first deal under contract. We tied up the deal. It ended up falling through. And the broker that we were working with grew up with my dad on North Capitol Hill. And when it fell apart, he said, hey, this might be too early, but I have this property that I own. I just lost my retail tenant. I think it would be a great redevelopment site for infill multifamily. You guys should take a look at it. So he sent it to us, and it was this fantastic site right at the Alaska Junction in West Seattle. And it's a deal that we had no business buying. Had we fast forwarded again, 3-4 years, you would have had Alliance and Wolff and Wood Partners and TCR and all the big players that are well capitalized at the table. Nobody would have even answered the phone if we would have called. But because I had this personal relationship, because the market was depressed at the time, he gave us a look. And to this day, I'm still shocked that we had that opportunity, but it paid off. And so that was really kind of our start at Urban Evolution for my partner, Matt Corsi, and I. He currently runs Carmel Partners here in Seattle. And we took that deal and kind of ran with it. And that's ultimately kind of what connected with the Wolff Company.
Yeah, maybe touch on the Wolff Company connection and kind of how that relationship began to develop after that first deal and kind of where it's taking hold. It's pretty cool.
So I think we tied up that site in maybe June, July of 2010 or 11, maybe it was 2011. And we'd identified another established firm here in Seattle. We went to them and said, hey, we've got a great development site under control, got a great team behind it, hired an architect, you know, an engineer, and had put the feasibility study together, has basically put the whole package together to submit for our EDG to the city. And we were still in diligence, and we went to this partner and said, hey, we need help raising the capital. Like, we've never actually done this before. As the sponsor, you know, the capital markets are really challenging right now. And so, you know, we'd like to use your pedigree to partner, you know, co-GP this with us. And you represent the capital stack, we'll manage the development process, and we've got a great deal in tow. So they said, this looks great, we love the deal. 3 weeks before we were supposed to go non-refundable with $250,000 on our earnest money deposit, the partner called us and said, hey, we've been super tied up with a bunch of other things that we're working on right now. We can't deliver. And so up to this point, this was really kind of our launching point. And Matt and I kind of looked at each other and we said, well, shit, we got to find a way to get this done. And so we had 3 weeks. We literally met with everybody in the city. Anybody that was doing anything in the capital markets and apartment development, we called them, we sat down with them. Everybody loved the deal. They had 3 weeks to commit $250,000, and that was kind of the gating function of like nobody could get around, right? It was like, love the deal, get more time, call us back. Sure enough, we could get more time because we already have the seller who's doing me a personal favor who didn't think we could get it done. So to go get more time and keep the deal off the market wasn't really a reasonable ask. And so, so Tim Wolff flew to town, who happened to be a fraternity brother of my partner, Matt, at UW back in the early 90s. And they were having dinner, just catching up. And the Wolff Company didn't have a presence in Western Washington at the time. And they were just catching up over dinner. And Matt was talking about the challenging situation that we had found ourselves in. And Tim kind of stopped him and said, hey, you know what my family does, right? And Matt was like, oh, you guys do development in Spokane or whatever. He's like, well, actually, like we moved the headquarters to Scottsdale about a decade ago, and we own 16,000 apartments now. And we just raised our first private equity fund. It's $300 million, and we want to get in Seattle. We'd love to look at your deal. And after dinner, Matt called me. He's like, holy shit, I think like we might actually have just saved our deal. And so like to the credit of the Wolff Company, like those guys flew up, I think 3 days later, Tim flew his whole team up, did the dog and pony, walked them around the site, toured the market with them. And like that night at dinner, they just committed. They said, hey, we'll put up the money. Let's, you know, co-GP this deal together. And it was a great kind of interlude into kind of introduction into the Wolff Company and kind of where things went from there.
Yeah, the rest is history.
History, yeah.
I think maybe dialing it back a little bit. A lot of us are kind of early on starting out in our careers. What are some of the skills that you were able to kind of look back on and say were kind of critical in the development of that project? And, you know, someone again starting out, what would you say is kind of the best way to proceed and kind of refine your skill set, if you will, to pursue?
Yeah, I think, you know, I think at that time, even though we had been in the market, so my partner Matt was a structural engineer. He did big, heavy, you know, type 1 Class A office buildings and sports stadiums and things like that for Magnus and Clements engineers here in Seattle. And he was, I think Matt's probably 15 years older than I am. And he always wanted to be on the development side. And so when we were in this program at UW, it was 2010. He got laid off. He was like the last round of layoffs at his firm. They went down from 150 people down to 30 people, and he was layoff like he was like man number 32. And so he got a great severance package, and he said, "Hey, I want to go try this. Like, let's go. I think now's a great time. Let's go do this." And I think, you know, one of the benefits for us at that time was like we didn't know what we didn't know. Like we knew enough to be dangerous, and like we knew how to, you know, look at a project and underwrite a project and understand the steps to kind of get it from point A to point B. But we didn't really understand the constraints of, you know, raising capital for the deal and, you know, all the challenges with, you know, getting a property fully entitled and fully permitted and all the constraints there. Because we'd always been on the other side of it where we had clients that we were kind of helping at kind of some segment of the deal, but they were the ones really kind of doing all the steps. And so I think for us, like going into it, because we were a little bit naive, I think we didn't really like limit ourselves. And so, for example, when we lost our capital partner, we had no hesitation like calling everybody in the city, whether we knew them or not. We would call them, and at the time, people had time to meet. Um, they could recognize that we had a good deal in tow, and they were willing to talk about it. But like for us, I think the takeaway is, I think at that time, it really kind of showed us that like in this city, people are willing to meet with you. They're willing to sit down. They're willing to mentor you. They're willing to sit down and talk about a deal. There's a lot of cities where that doesn't happen. And here in Seattle, the amount of people we were able to meet with through that experience actually allowed us to develop a lot of good relationships, make a lot of good connections. And so I think to kind of bring that back to your question, part of it is at the end of the day, I think everything that launched that deal for us was personal relationships. My relationship with the broker, Matt's relationship with Tim Wolff, and then just our ability to put a team together and have architects and engineers take risks on us to go do a bunch of work hoping they get paid because we'd never done a deal before together. And it was this new company and we're going to go spec time and hope that this invoice gets paid. But we were able to do it because we had, established relationships through in this city in our career prior to that point. And so, this kind of ties into the NAIOP plug. I think early in your career where you can make a lot of connections, make a lot of relationships, it eliminates a lot of layers of constraint. If you have a problem that comes up, you know who to call. I met this guy at this NAIOP event. He's a, geotech engineer and I have a soil problem. I know nothing about it, but I'm going to call him and gotta understand what's going on. I think people take that for granted. In a lot of industries, one of my partners now used to be in the hedge fund business, and they would look to go invest in a sector, and he would have to become an expert on it, like overnight. And so for him, it was like, okay, we're going to go invest in this company that's manufacturing steel in China. Okay, well, now I need to learn about manufacturing steel. I need to learn about the geopolitical business constraints of doing business in China. Like he had to become an expert on this space in like a very short amount of time. We don't have that constraint. Like if you're involved in this industry and you do it the right way and you make the right connections, it kind of allows you to be lazy to a certain extent, right? It's like you can just pick up the phone and I can call Steve and say, hey, can you pull a preliminary title report on this site that we're looking at? No problem. They'll send it to you. So I think early in your career, just making the most connections that you can is super important. And I think just being an expert in your market. I mean, that's where you're going to get ahead, whether you're talking to a capital partner, you're talking to a land seller, you're trying to get promoted within your organization. I think being the smartest person that's just put in the time, that's like, they know every transaction, they know every player, they know every data point. That's well within your control, right? It's just a matter of effort. Like, can you do the hustle and like get smart on that kind of stuff? Because at the end of the day, like that stuff comes out, right? You're going to be in a situation where you've got the answer that somebody else doesn't have, and either it allows you to win a deal or it allows you to look good in front of whoever you want to look good in front of, and you end up being in a good position at that point in time. So, I mean, I think those are really, for me, if I had to give somebody advice early in their career, it's like meet as many people as you can and know as much as you can. If you do those two things, like you're going to find yourself in a good opportunity.
It's great advice. I think my favorite thing about Seattle too is just how close knit this can be. It can also sometimes be a curse, but overwhelmingly a good thing. And that just comes back to mentorship, which you mentioned. And I think it'd be interesting to know some of the early on mentors in your career that maybe helped you and kind of what some of the keys are and either identifying a good mentor or things to effectively.
Yeah. No, it's a good question. I think you first have to understand like what is it that you want a mentor for, right? Because you can have a mentor, in life, like how do I be a good friend to people? How do I be a good son? How do I be a good father and husband and whatever it is that you're into, right? So like that's one person that's very different than like a professional mentor, right? And so, and even professionally, I think understanding like what is it that I want to learn, right? Do I want to learn how to grow in my company, grow in my career, or do I want to learn how to, draw a path to go out and do this on my own? And maybe somebody that's done that is a better mentor than somebody in a company that you work for, right? So for me, I think I've had a couple. I think the person that I learned that I wanted to be a developer from was William Justin. And his name's not as Steve would know his name. He was a big prolific guy in the city for a lot of decades. I think he was the head of what is today SDCI in Seattle when he was 30. So this is going, I mean, he's probably 80 now. But so, back in the whatever decade that was, he was 30 years old. And he was the head of this department in the city of Seattle. And from that, he ended up doing a lot of prolific things in the city. He assembled all of the land that is now Fred Hutch and kind of put that whole thing together. Did a lot of big towers in the city, developed a lot of office parks. But anyways, he was doing 1521 Second Avenue, which is a big luxury condo tower right above the market here in Seattle. And I had the privilege of working on that project kind of early out of college. I think it was probably 23, 24. And I just remember like his command of everything. Like we would go into design meetings with architects and he would talk about like canting the tower a certain way, which then opens up views to certain corridors. And he knew that because he had gone up in the buildings that were adjacent to that tower and like looked at those corridors. And there was so many little things like that you kind of just learn throughout your career that if you're 22, 23, 24 years old, like you're never going to know unless you meet a guy like that or a girl like that, that is really thoughtful and experienced, right? So I think for me, he was the guy that I was like, I want to do that. Like, I'm just going to watch what you do and I'm going to figure out how you do it. And I'm going to go do that. And then I would say my real mentor is probably Tim Wolff. So he was the one that brought me into the Wolff Company. He's probably one of the best people that I know. Really, truly cares about people first. And I think in business today, like people will act that way or they'll say the right things, but their actions don't necessarily like follow that. Tim's somebody that actually does that. And he's probably the best deal guy that I've ever met. Like his ability to go in, develop a relationship on a deal where you may not have the best terms, right? You may not have the most capital, but you win the deal because the broker or the owner want to do the deal with you, right? And that was a special skill that he had that I've kind of tried to emulate. It's, that's kind of where, that's kind of the magic in this business. How can you, when people talk about asymmetry all the time. It's like one of the most overused terms, and I hate when people use it because they actually don't know what it means. But I think that is a great example of like an asymmetric outcome, right? Where you don't have the you don't have as much capital, you don't have the highest price, but you win the deal, right? And you shouldn't, but you do. So I think finding people like that for me, those were both outcomes that I was trying to achieve. I wanted to be really good at what I did. And I saw Tim was really good at that thing. And he was a really good leader. And I was like, I want him to be my mentor so I can get good at this stuff. And with William, I recognize I want to be a developer. You're the best one that I know. And I'm going to follow what you do. So for me, I think it's really about like being specific. Like so you're going to be impressed by a lot of people, right? Or you're going to see people doing things. And you're like, hey, that's attractive to me. It doesn't mean they're going to be your mentor or they should be your mentor. They could just be somebody that you look to as somebody you want to keep your eye on. But I think just being deliberate about finding a mentor is probably the most important part from my perspective.
Well, that's great. And thank you. That's super helpful. I think kind of segueing from that to maybe talk a little bit more about, so from your first deal in West Seattle to then being kind of brought in and working with Wolff, what was that transition like from kind of a solo venture that you had started out with your partnership and then transitioning more broadly into being a part of Wolff?
Yeah. So the West Seattle deal was the first deal we did with Wolff. That was our first introduction. And they had just raised their first fund. It was $300 million. They didn't have a team in Seattle. This is going back to 2011. Seattle was really an attractive market at the time. Amazon was relocating. They were growing their presence here. Fundamentals were really strong. And we ended up being an easy solution for Wolff because at the time, the market was really waking up and opportunities were being presented and we were the tip of the spear in this market. So we would find deals, we'd bring it to them. And it got to the point where early on, they intended to build a team here in Seattle and we gave them a reason not to, right? It was like, hey, Urban Evolution's building our pipeline. We can kind of put that hiring decision off to like grow an office in that market because we got these guys that are doing it for us. And for them, they could actually charge the costs that we charge them to the deal rather than charging it to their own P&L. And so that was also an advantage that we had recognized early that, hey, if we bring you deals, you can charge our costs to the deal, and that actually makes you guys more money. So I think identifying that early on, you recognize we need to be the one bringing them the deals. We can't wait for them to find deals and then call us, right? So that was really the first intro with Wolff. I think from 2011 to 2014, we ended up doing approximately 6 deals, mostly urban infill deals here in Seattle. So the first deal that we talked about, West Seattle, it's called 4730 California. It's got a Chipotle and a credit union in the base of it over in West Seattle right now. We did the Pike Motor Works project up on Capitol Hill where the Red Hook Brew Pub is. Really kind of interesting geometric site that kind of touches 4 blocks, but we don't have all the frontage on all the blocks. We did the Sunset Electric building that kind of sits right behind the East Precinct on Capitol Hill on Pine. Did a big project down in Columbia City and then a type 1 mid-rise deal up in Salt Lake Union. So we did all those deals as a third party to Wolff. And finally, Wolff said, we can't rationalize using you as a third party with the amount of work that we have and what you guys cost to these deals. You know, our partners in our funds are going to say, hey, you guys are doing enough business here. It makes sense to internalize this and open an office in Seattle. And so Tim Wolff came to me in early 2014 and said, hey, your contract's going to expire. I can't rationalize like continuing to facilitate this relationship. So I want you to open an office in Seattle and I want to internalize this. But you have to leave your partnership to do this. And so it was a really challenging decision. And, you know, through that, it really kind of forced me to kind of figure out, like, what do I want to do with my life? Like, we're making a lot of money here doing this. We built like a decent company, you know, a decent private partnership. But what does that mean? You know, I've got a lot of runway left. I think at the time I was probably 30 years old. And so I really kind of did a lot of thinking and kind of soul searching then. And I just decided this was the move I wanted to make. So I'll spare you all the details. I ended up leaving my partnership, you know, on good terms and opened the office for Wolff. And so we did that in kind of mid 2014. And from kind of that point in time to when I left at the end of 22, you know, we did a lot of business up here in the Pacific Northwest, and it proved to be the right decision. But at the time, it was a hard one.
Yeah. Well, you touched on sourcing deals earlier, and I guess I kind of want to dive into that one a little bit further. What would you say are some of the keys to identifying and sourcing deals in this marketplace? Like, what are characteristics you look for, or what are you mostly broker driven? What are some of the tools you use in that interest?
Yeah. So our firm now, Fourth Avenue Capital, we buy existing deals. We also develop. But historically, you know, we really kind of formed this firm in early 2020, kind of the onset of COVID. And up until about a year and a half ago, everything we did to build our pipeline was through stabilized acquisitions. And, you know, in that business, it's really hard to buy assets off market. You know, you get calls from brokers all the time. They say, hey, I've got this great off-market deal. And it's like, okay, you just called 10 other guys. So like, it's off-market, right? You didn't build an OM for it. I get it. But on the land side, I have probably only bought 2 sites that have been widely marketed. And that's a place where off-market, like true off-market, there's really a lot of like value creation to be had. And so, you know, generally, I think where we've been effective doing that is, you know, being really deliberate in like, what do we want? Like, what's the product we want to build? What's the scale of the product we want to build? What are the geographies we want to build in? Within those geographies, where do we want to build, right? I mean, you can take a neighborhood and you can say, hey, I want to be in Ballard. I don't want to be on 15th, but maybe I want to be on 24th, or I want to be on Market, or whatever it is. But really kind of then narrowing in, because when you take that and you say, okay, I want to build this product, I want to build it at this scale, I want to build it in this narrow geography, the options kind of like boil to the top like pretty quickly. And so I think we've been effective there when I was at Wolff and also today at Fourth Avenue, in just really being deliberate in terms of what it is that we're trying to do and not like chasing shiny objects as things pop up that aren't within the box that you created. And then I think it's really just a matter of like understanding value and being creative in terms of deal structure. I think that's probably where we found the most success is when you're buying deals off market, you're generally dealing with sellers that aren't looking to sell the property. And so you quickly need to understand like what are the things that are attractive to that person, what are things that are not attractive to that person. And then being flexible in terms of how you structure a response to that that then addresses those constraints. And look, 9 times out of 10, the person still says no. But 1 out of 10 times, like you can effectively address that and you unlock a deal. So I think those are really kind of the 2 takeaways that I would say is just being very focused in what it is that you're looking for. I think that allows you to really kind of focus in on real opportunities rather than kind of constantly chasing, hey, this land listing came up in Marysville and there's this other one that's in Bellevue and one in Olympia. And it's like, what are you doing? Right? I mean, like, is that really what you want to do? Or do you have a box that you want to focus on? And can you really kind of narrow down on what's most addressable?
That's great. I think one of the big things to touch on too is now you're transitioned out of Wolff, starting your own venture again, and maybe just talking through that transition, and then what it's like kind of taking the leap from kind of being in a stable position and then kind of ramping it back up into being 100% your own boss.
Yeah, it's a good question. I think if you're a developer, if you're a deal guy, like inherently you're an entrepreneur, right? Like every deal is a mini business, right? And I mean, even legally, I mean, usually you're structuring independent partnerships for each asset, right? And so I think if you're drawn to that business, like you're naturally more entrepreneurial by nature. I think at the time, going to Wolff was a great transition for me. It allowed me to work in an institutional shop. I gained a lot of institutional skills and knowledge through doing that. Got to do a lot of deals, right? And I think it's like baseball. Like the more at bats you have, the better batter you're going to be over time. And so I think working in a bigger shop earlier in your career, one of the benefits is it gives you that opportunity to get a lot of at bats. But I think through that, I recognize that it's like, hey, I know my market really well. I have conviction in my ability to see opportunity and see risk, and usually what I found over time was most cases I'm right in a narrow band, right? Like when you establish that box, again, it allows you to be an expert, right? And if you can do that, then you can get really good at just seeing opportunities, seeing risk, rather than if I were to go into, Louisville, Kentucky to go do a deal today, I know like 50% of the things I need to look for in a deal, but the other 50 are unique to Kentucky or unique to Louisville, right? And so I think what I found was I was working for a firm that was based in Scottsdale, great people, great platform, but I didn't like somebody else creating the box that I had to go pursue because it wasn't necessarily aligned with where I saw opportunity. And so I think that for me, it became clear, hey, I need to go do this on my own. And then it was really more a function of how do you transition to get to that point where you can do that? And, when is the right time? Because I think in our business, you can never, anybody that says we're going to time the market, we're going to wait till the next downturn, where there's a buying opportunity and we're going to go do this thing. It's like, you don't control any of that. You don't know how that's going to happen, how that's going to come about. People were saying we were in the 7th inning starting in 2014. That market cycle went all the way until COVID hit. And then we came out of that pretty damn quick. And that cycle kind of kept going. But I do think seeing opportunities in the moment, right? Not like trying to look forward and say, hey, I think a downturn's coming in within a year or 2 years. I'm going to get ready to mobilize and take advantage of that. I think it's rather like looking around at the landscape and saying, hey, there's opportunity, right? Like people are pulling back. I'm seeing listings sit on the market longer. We're in the middle of it right now. And so I think through my decade at Wolff, it became pretty apparent like, hey, I got to get back and I got to do this. COVID allowed us kind of the opportunity to put pencils down. So I have two partners in my business, and we were all kind of pencils down in the businesses that we worked in from kind of when COVID hit in March to, for us at Wolff, we were really pencils down until kind of October of 2020. Um, and so during that time, we saw a lot of opportunity in the market. Interest rates have dropped precipitously. Um, Buying activity, buyer interest in the market was down significantly because everybody's trying to figure out what to do with COVID and, eviction moratoriums and stabilizing their portfolio. We just saw a huge market opportunity and we have the time to do it. So I think that for me, that was really the identifying that was a place I wanted to end back up, ended up, wanting to be back in the entrepreneurial seat, but then also identifying a market environment where it's like, now's the time to strike. If we're going to do it, we're not going to find a better time. Let's go do it now.
It's great. What was it, I guess, too, about your partners, and how did you kind of come into meeting your current partners now that kind of helped you formulate for that?
Yeah. So it kind of goes back to like one of these earlier themes. So one of my partners, Davis Vaughn, ran acquisitions at Security Properties here in Seattle for about a decade. I got to know him through NAIOP. We were on the DL committee together back in kind of the 2010 to 2014, 15. And kind of got to know him tangentially. I mean, it wasn't like we became like super good friends or became super close. But through NAIOP in 2016, I started buying deals on the side, separate from Wolff, and it was completely above board. They weren't deals that were competitive with Wolff. But through our relationship at NAIOP, Davis knew I was doing this, and he had a similar ambition, and he got a hold of a deal in Spokane, didn't have the ability to raise the money, and called me and said, hey, I know you're doing this. I've got a great deal. If you want to partner with me and go raise the capital, I'll joint venture with you. And so we ended up doing that together. And so from that point forward, we weren't formally partners at the time, but we were kind of looking to do more deals together. And so when COVID hit and the opportunity to go buy a lot of deals quickly kind of became apparent, it made sense. Like, let's organize. Like, why don't we actually formalize this? Let's work together. And that started, I think early on I identified like, this is going to be the market cycle. This is the market correction where we can actually go start something and scale it. And so it forced me to think about what's the structure of that business? What are the talents that we need, the human capital that we need in this business to be effective? And going back, having the benefit of starting with the Wolff Company back in 2010, 2011, we did our first deal with them. I think there was 35 people in the firm at that time. When I left, there was 250. And so I got to see kind of the growth curve of that business from relatively small to a big institutional business. And so I was able to kind of look at that and say, what were the components of that business that added a lot of value? And how do we replicate that on a really small scale? So in looking at it, we wanted to be kind of multidisciplinary, and we wanted somebody at the top that could represent the different business lines that we wanted to pursue. So I had the development background. Davis had a very robust acquisition background. And then there was one of my partners now, Brian Betts, was in the hedge fund business in New York for about 12 years, retired young, moved back to Spokane where he was from. And I got to know him because he decided to he became our head of research at Wolff for our private equity fund, knew Fritz Wolff, and just decided, hey, like I got to get out of the house every day, get away from my kids. I got to go do something. And he and I kind of built a relationship flying around the country together at Wolff. And he left Wolff a month before COVID hit, just on his own. He just decided it wasn't right. And so when Davis and I formed, I had a partner prior to that who was a real estate attorney. And so I was looking at kind of the landscape and I said, okay, I've got the development piece. I want a multidisciplinary fund or firm where we can buy assets, we can build assets, we can raise capital, and we have somebody watching the store. And so with my partner at the time, who was a real estate attorney, super sharp organizational leader, we had the organizational piece, the COO, so to speak. I had the development piece, Davis had the acquisition piece. What we were really missing was like who's that capital markets guy that can go out and bring in family offices and really kind of find non-institutional capital. And Brian, through his connections on Wall Street in New York, had a lot of historic relationships that I knew we could leverage. And so really it was I think April of 2020, we all came together, the four of us formally started Fourth Avenue Capital. And that was really the catalyst that kind of started the whole thing. It was that multidisciplinary function where we had a guy that could raise capital, be a great investor relations guy. We had acquisitions, we had development, we had operations. And it was like, okay, now we have a team that we can confidently go out, we can sit in front of a family office, we can raise large amounts of private capital, knowing that it's not just Chris going out and buying a deal and raising money from family, friends, and people that I know in AOP and, your personal network.
And what's kind of next for Fourth Avenue Capital? I guess what is the current status of the company and kind of what are some of the deals you're targeting on a go forward basis?
Yeah, so fast forward from Q2 of 2020, today we own 20 assets. Our focus is multifamily real estate in the Pacific Northwest. And so, we own today in Oregon, Washington, Montana, soon to be Idaho. And that's really our box that we've created. We have a team of 8 people now. We have offices in Spokane and Seattle. And the reason that I left Wolff at the end of 22 was we saw a great opportunity to go buy land opportunistically as a result of this market downturn. And so really the intent was to go now launch a development division. I couldn't do that while I was at Wolff. And our portfolio grew to a size that it just didn't make sense for us to kind of wear 2 hats any longer. So starting in kind of January 1 of 23, really the focus kind of shifted to building a development business. And so today we've got a pipeline of 3 development deals. We started construction on our first one about a month ago. So that's 240 garden apartments in Spokane. We've got a deal in Bozeman, Montana. That's another 216 apartments that we start on next year. And then we have another deal down in kind of the Portland suburbs that we'll start on next summer as well. So, going forward for us, we're very much in growth mode. And I think our thesis right now is that the worst of this correction is behind us. I think what we're going to see is going into 2025, the market's really going to start to heat back up. And we're already seeing kind of the early stages of that, right? Sellers are coming off the sidelines. They recognize that, now is the time to really start to position themselves to maybe transact and get out of deals that they don't like and be able to reposition it in new deals. We're starting to see people get hired again in the business. We're actively, we've been hiring people. And so I think going forward, you're going to see a great opportunity from, 2025 through whenever that next cycle ends, to really go and kind of expand deal flow to build the business. And that's really what we're focused on right now. So, our business is focused on buying assets that we can own long-term. I think our experience in this business, we've seen a lot of different models and different people and that have done this in different ways. And I think what we found is that, if you're honest, if most players, that own assets or develop assets are honest with you, they would tell you that all the stuff that they sold 20 years ago, they wish they still owned and didn't sell. And so for us, we're very long-term focused. We put long-term fixed rate financing on all of our acquisitions. It's relatively low leverage. I mean, we're typically financing acquisitions at kind of 50 to 60% of cost. Very high debt coverage. We have fixed interest rates on all of our loans. And so a lot of the trouble that people have been going through as, they put on a floating rate of 3.5%. Now today it's 7 or 7.5%, and their debt coverage is negative. We've been able to buy with a long horizon and be conservative in our capital stack to be able to really focus on growth rather than having to deal with problems when times get tough. So I think going forward, it's really, it's building human capital in our business with really good people that we know are going to be with us for a long period of time, and we can incentivize them to benefit as the company grows. And it's really a matter of kind of just continuing to do great deals and grow the portfolio.
Well, Chris, thank you very much. Appreciate your time. I want to make sure we get a couple of quick questions too from the audience. The first quick lightning round for you. Favorite Seattle restaurant?
That's easy. Eden Hill on Queen Anne is by far my wife and my favorite restaurant. Right. If we have a babysitter, that's where we end up. We can walk from our house, usually just sit at the counter, and it's like awesome people. So if you haven't been there, you should go. Fantastic food, awesome staff.
Favorite book?
I don't know that I have one favorite book. I think I tend to be drawn to nonfiction, and I tend to be drawn to kind of autobiographies, generally people in our business or in finance that, tell. I think we're in a really unique time in the world where you've got all these super successful people that started out like people like all of us, and they ended up finding an opportunity and growing a business. But we're at a point in history where people are like really open about telling their stories. Like, I think if you went back like 30, 40 years, you had all these like tycoons that like nobody really knew exactly how they got from point A to point B. And now you have all these books and podcasts where people will literally sit down and say, like, there was a point in time, like I mortgaged my house, and I felt like the stupidest person in my industry, and all of a sudden now this guy is one of the biggest companies in our business, right? And so a couple of those books I think that are pretty good. I really like Sam Zell's book. Steve Schwartzman's books. I think hearing the stories good. I think he's a little bit kind of self-grandizing in this book, but it's a good read. But yeah, I think just hearing other people's stories, and especially when they're like brutally honest about what they've gone through, I think that it's a great opportunity to kind of find some support, for lack of a better word.
Well, thank you. I think we have time for just a couple questions if y'all have any, just a few minutes. So opening it up to you guys. Yeah.
Where do you see the opportunities now? Because as a developer, it's been really tough, right?
Yeah.
So your relationships probably really helped with finding sourcing capital, but like, let's say you started over and like build to rent was a big thing. Like, is there a niche asset type or submarket that you would go for?
Yeah, it's a great question. How much time do we have?
Like Rossman is on there.
Yeah.
Like you ski or
No, so when I was at Wolff, our last fund that we invested was $1.5 billion. And to do that, you can't just be a market participant where it's like, hey, a site gets listed, we're going to go buy it, we're going to build a 250 unit project. You have to be really deliberate in terms of themes. So in that business in 2016, we took a really hard pivot to the suburbs, and we just said the capital flows and all the development pipeline are going to the top of the pyramid, high income earners in urban environments. We think that there's this huge unmet demand for kind of the person making 100% AMI. That's not low income housing. It's just, it's normal people in communities that are in the suburbs, right? Or secondary markets. And we were hugely successful in that because nobody else had gone there. Like, the market opportunity was huge. Sure enough, 2-3 years later, all of a sudden everybody kind of came to the same conclusion and went there. Similar with BTR, we had a big BTR focus right before COVID, and we're building a big partnership with Lennar, the single family home builder across the country, to go through that. And so, I think and we were big in senior housing from 2015 to 2020. And so that was part of the education at Wolff. We were always kind of looking at like, where are kind of the secular shifts that we kind of need to be aware of. I think going forward, so in our business, we very much focus on those themes. I think going forward on the development side, what's been really challenging over the past couple of years, you look at office and there really is a secular shift away from office, right? And so, and I can't really speak to that market. It's not what I do, but I think from the outside looking in, if I'm an office developer, it's going to be very challenging to say, hey, this is a short-term problem. We're going to be back in the market in a year. On the housing side, it's a math problem, right? We haven't had a fundamental issue over the past couple of years. It's just interest rates ran aggressively and cap rates followed suit and costs didn't, right? And so, when you're building an asset in a cap rate environment where you're anticipating, building to 100 basis points of spread, over prevailing cap rates, and cap rates are 4%, you're building to a 5, and then interest rates run by 150 basis points, and now you can't build an asset to a positive profit margin, your business is just irrelevant at that point, right? So I think going forward, being able to kind of look beyond that, just knowing that you can't control the capital markets, they're going to do what they're going to do. But I think looking at opportunities, the market has to correct. And we're already seeing that, right? The Fed's already come out. They're already going to be pulling back next year, this month. And I think what we're starting to see is that, that pendulum starting to swing back. And so I think it starts with kind of looking at the fundamentals of the market, right? The product type, who your user is, the geographies that you're in. Are you in a growing market? Are you in a contracting market? And then just knowing, hey, the macro picture is going to correct itself. So I want to do the best opportunity that I can find in a market with a product type that I have a strong conviction in, and capitalizing it in a way that gives you that safety net where it's like, we don't have to have the market come into like a perfect equilibrium for us to be successful here. Like if the market stays in this environment or gets marginally better, it's still a good deal. But I think housing, that's what we do. We're very bullish on housing in the Western US. And I think that's going to manifest itself in different product types, BTR, rental housing, single family, for rent, multifamily.
Was an office leasing broker that
You can speak to it better than I could, but I think,
Anyone else? I think we have time for one more.
I have a question. In a world where you're not well capitalized and you're one of us that's just trying to get into it, based on your previous answer, if you had the choice between now investing in single family homes or buying a duplex or a quadplex or something like that, which one would you choose and why?
Yeah. So the first deal I did on my own was in 2016. It was 12 units in Marysville. And I called my best buddies. I called my parents and my friends. I called friends that I knew had liquidity to invest and had interest in the apartment market. Fast forward to today, we have 800 investors in our private capital network. We have 4 large family offices that we work with and a couple institutions. And like, what's happened from 2016 to 2024 is just we've kind of forced growing that network, right? And so first deal was 12 units. The next deal was 44 units. The next deal was 74 units. And once you start doing, so I'm not going to answer your question directly in terms of like, is it a single family? I think what it is you got to kind of get in the stream and do a deal and then talk about what you're doing to people, like deliberately talk about it, whether you're like a dinner party or an industry event or whatever it is, because everybody loves like personal investment. Like it's so much more interesting than like what everybody's doing in their day jobs. And so being able to talk about that, I think you'll get feedback from people where they're like, hey, that sounds awesome. Like I'd really love to get involved in that. When you have another deal, call me. And then all of a sudden this network effect happens and the ball kind of starts to roll down the hill on its own, to the point at which you'll get, we get phone calls from people that say, hey, I know you have another deal out that you guys are racing for right now. I was at dinner on Saturday night with David and Gina, and they were telling me about it, and I'm in for X amount of dollars. Who is this? Like you just committed 6 figures to a deal that you don't really know anything about. You've never met me. It's crazy, right? And so I think what's most important is like do something. Like do something with a thesis that you can build upon, and then be deliberate about like, every time from 2020 to 2021 to 2022, and so on, as we kind of continue to build our capital network and build our portfolio, we consistently challenge ourselves with, it's like, hey, we just did a deal, but this other great deal just popped up. And both of these, for whatever reason, really kind of fit our private syndication network better than a family office, for example. But we just raised a deal and we just tapped out that network. Should we do it? And so we have a lot of debates around this. And usually people's personalities like are consistent, right? Like usually we have somebody that's like, we can't do it. I know it's a great deal. We got to wait. I'm always like, hey guys, look, if we're going to build a big business, like we got to do every deal that we can. You find a way to do it, right? And so forcing ourselves to consistently do that has allowed us to grow, right? Putting ourselves out there, challenging ourselves, it forces you to like make that extra connection, like ask for introductions from people that may be an existing investor or a referral. Because once you hit somebody, like you open up a whole other network, and with all those people, they have a whole nother network, right? And so I would just say, like, start doing it and don't be quiet about it. Like, talk to your friends about it, talk to your contacts about it. And if you really want to do more and more and more, there's a very organic way to do it. My only advice there is, like, don't try and do it faster than you should, right? I think that's where we see people fail, where it's like, hey, I want to build a portfolio of this size or make this much money as quickly as I can, and people make bad decisions when they do that. And so I think if you do it in a way where you're truly managing risk appropriately, you know, you're working within kind of the constraints that are, you know, you identify what those constraints are, I think you'll prevail, right? Like, you'll succeed. It's just may take a little bit of time, right? But
Thank you, Chris, again, for taking the time, sharing everything with us. And thanks again to our sponsors. And then lastly, we do have our September breakfast next week, the Women Who Build Seattle, Wednesday, September 18th at 8. So please make sure to sign up if you can and are around. And Chris, thanks again. We'll have drinks and stuff around, so
that's
feel free to
great.
stick
Yeah.
around.
Thank you all for being here.